Good morning, everybody. Thank you very much for joining our webinar on B ownership. I just want to introduce myself. I'm Eric Ackroyd. I'm the Chief Operating Officer of Diversifi and also a Transformation and Ownership Specialist. Joining me today is Anton van Geest, who's our Transformation and Ownership Specialist. So together we'll be presenting the webinar to you. Just to take you through the Alternative Prosperity Group, on the far left, we have Diversifi, which is the B advisory business. Myself and Anton are in this business, and we consult and advise on B ownership, all other B aspects. We look at transformation strategies and also diversity, equity, inclusion. Our sister company, Y.E.S, looks at particular B solutions. So when we do a strategy, we look at Y.E.S to assist clients to find solutions around skills development, learnerships, enterprise and supply development, all the different solutions that are available to the scorecard. And Y.E.S is a platform that have vetted and done due diligence on approved suppliers and then facilitate the solutions pertaining to the BE scorecards. We have a company called Six Capitals, which is an advisory firm for environmental, social, and governance, ESG, and then also does development and finance development. Another subsidiary, DNA Economics, looks in particular to economic development consulting and research around those topics. Then we have Value Capital, which is a corporate finance business looking at valuations, listings, M&A, and also further be structuring together with the Diversifi team. On the social impact side, we have Atlega Edu, which is a consumer financial education business, particularly specializing in trustee, pension fund trustee education and other consumer financial and education initiatives. They employ publications, audio, video, and workshops as mediums to do this communication. Furthermore, we've got the Alternative Prosperity Foundation, which is one of our shareholders, and the foundation looks particularly to development programs for youth, women, and also with a focus on diversity, equity, inclusion. So that's the Alternative Prosperity Group of companies. Our agenda for today, firstly, is to take you through some alternatives to ownership, in particularly the once empowered, always empowered or continued recognition principle, the sale of assets, and then the equity equivalence principle or statements. And we will be looking in particular to the generic codes of good practice. A next topic is the Youth Employment Service, which can also be used to counter the discount applicable to if you do have no ownership or a very low level of ownership. Anton will then take us through complex calculation, talk through the ownership calculation methodologies and the more complicated areas thereof. We'll also look at risks in terms of ownership structures that one needs to be aware of and how one can go about to mitigate these risks and also simply just try to avoid any of these risks. Right, just looking at these alternative forms of ownership. Firstly, if we look at the ownership scorecard, I think what we very often miss is that there's 25% target for Black ownership, but there's also 75% available on the scorecard for non-Black ownership. So it's not entirely a Black BEE ownership scorecard. There's definitely space for other shareholders as well that are not qualifying as Black people. When we look at continued recognition, the continued recognition or once empowered recognition adds to any current Black shareholding. And then also the sale of assets recognition also adds to your current shareholding, to your continued recognition. So all these different forms of Black ownership can be accumulated and added to the ownership. The equity equivalent investment program applicable to multinationals or certain multinationals replaces the ownership scorecard in the way that you can get either 25 points or proportionately 25 points, but no black indicator percentages are allocated. So firstly, if we look at the continued recognition, the objective of the once empowered, always empowered, or continued consequence is to facilitate liquidity for black shareholders so that the black shareholder is not locked in or finds it very difficult to exit. That where a black shareholder had made some money on an investment, that there is a facilitation of them to exit and then to go and reinvest their net value in other investments. So in this mechanism, the continued consequence provides for a continued benefit for a period of time for the measured entity. And this facilitates an easier exit of the BE shareholder. There are certain restrictions pertaining to the continued consequence. The first is that the score is limited to 40% of the total available points. There are 25 points available on the ownership scorecard. 40% of that 25 points is 10 points. And important to notice is that the codes talk about the scores. They're not talking about the indicator percentages. And a common understanding in the industry is that the score gets capped, but the indicator percentage are not capped. And this is based on the wording of the code that talks particular to the score or the points that are capped. A further restriction is that if the continued recognition, if it qualifies, that continued recognition can be counted for the same period that the black shareholder was invested in the measured entity. And that is subject to the investment at least being 3 years that the shareholder was invested, and that is one of the qualification criteria that we will look at. The qualification criteria, as mentioned, firstly, the black shareholder must have held the shares for a minimum period of 3 years. Secondly, net value must have been created in the hands of the black shareholder. And then also transformation must have taken place. And in order to look at this, this is by looking at the BE level from the date of commencement of the shareholding by the black shareholder until the date of exit. And if the BE level has improved over that period, we meet this criteria. A further criteria for the loss of shares is that there needs to be a tripartite agreement between the measured entity and the lender of the funding. This is, however, not a requirement where the measured entity is the lender and there is a vendor funding arrangement in place. So the calculation methodology, if we simplify this methodology and we break it down into, let's say, in principal calculation, firstly, we need to look at net value that has been achieved on exit. So what is the value that is being realized, less the value of any acquisition debt? We consider that net value, and we then multiply that with the BE credentials upon exit. So the net value is converted to the percentage using the net value methodology. We multiply that by indicator percentage with the BE credentials of the exiting black shareholder upon exit. So we would use the voting rights, percentage of voting rights of black people, voting rights of black women, economic interest black people, economic interest black women, then the black designated groups or broad-based employee schemes, and black new entrants. And we would multiply that out. Then we need to calculate a continued consequence recognition percentage. This percentage is calculated by looking at the entire scorecard, the most recent scorecard. We then exclude the ownership allocated points. So on the generic scorecard, we take out the 25 points from the 111 available points. We also take out on the numerator, we take out the actual points that were achieved for ownership. we recalculate the new totals of the scorecard, both the allocated points as well as the achieved points. We take those totals, divide them by each other to get a percentage achieved performance on the scorecard. That is then multiplied by the total available points being 111 on the generic scorecard. We plot that on the BE matrix to calculate what the BE level is, and we then look at the procurement recognition percentage. And that percentage is then used in my formula as the continued consequence recognition percentage. Important on this calculation, the net value upon exit, that is calculated upon exit, that is fixed. We would then annually, we would update the continued consequence recognition percentage based on the most recent BE scorecard. And that being annually updated, and for the same period as the black shareholder was invested initially, subject to being at least 3 years, we would annually reperform that calculation by updating the continued consequence recognition, and we would then add that percentage to the current black shareholding in the scorecard. An important thing to notice is that one needs to check that you are not exceeding the 40% threshold. So you're not exceeding more than 10 points that is arising from continued consequence. And in short, those are the principles involved in the calculation methodology. On the continued recognition, there's no requirement to register with a BE commissioner. The initial black ownership transaction, if greater than 25 million in value, does need to be registered with a BE commission. However, when the black shareholder exits, and we can now quantify continued recognition or continued consequence, that recognition does not need to be registered with a BE commissioner. Looking at the sale of assets recognition, the statement 102 of the phase 2 part of the BE codes specifies that a seller that has concluded a transaction involving the sale of either an asset or an equity instrument or a business, a separately identifiable business, can claim benefits on the ownership scorecard that relates to this sale, and commonly referred to as a sale of assets in accordance of statement 102. There are certain criteria that needs to be met in order to qualify and in order to recognize the sale of assets. The criteria, firstly, is that this transaction needs to result in a viable business to the buyers, a viable and sustainable business, or business opportunities in the hand of black people. So we need to look at, is this asset that was sold, will this generate future income? Is it leading to a business that can be continued in the hands of black shareholders? A second requirement is that there needs to be a transfer of critical and specialized skills, managerial skills or productive capacity to black people. So there definitely needs to be a capacity and capability that is transferred through the transaction that will lead to future income. There may also not be unreasonable limitation on a business that is sold. So that means that no conditions which would restrict the business to certain clients, and also that there should be other clients, customers, or suppliers other than the seller. No unreasonable limitations pertaining to those aspects. This separate business must be shareholders that hold the assets for longer than 3 years. And what we look at here is also the 3-year period that is required for this before there is a fixing of the equivalence percentage. And I'll talk through that a little bit later when we look at the calculation methodology. A further qualifying criteria is that where we have outsourcing arrangements between the seller and this business that is being sold, those arrangements need to be fair, they need to be reasonable, and they need to be negotiated at an arm's length basis. The last criteria is that the transaction must be reviewed by an independent expert, and this expert needs to provide an opinion as to the reasonableness and the correct calculation of the voting rights and the economic interest that can be carried forward with the sale of assets. And then also the expert needs to provide an opinion on the net value points that has been calculated and that can be carried on the sale of assets. Once all of these criteria are met, and upon that being also the opinion being received from an expert, one can then recognize that sale of asset. There are certain criteria where you cannot recognize the sale of assets, so I'll call this disqualification criteria. And that particular is applicable to where you transfer business rights through a license agreement, through a lease, or similar type of arrangement, whereby the transferee does not receive unrestricted ownership. So any of those type of transactions do not qualify for the sale of asset recognition. A further type of transaction that doesn't qualify is where a franchisor sells a franchise to a franchisee. Those transactions don't qualify. However, where a franchisee would be selling a franchise to another franchisee, that type of transaction would qualify. A further disqualification is if the transaction has a repurchase agreement that is exercisable within the first 3 years after the transaction. In such a case, it would not qualify. Just looking at the calculation methodology in principle, so if we break this down into an easy, understandable way, we firstly calculate a sale of assets equivalence percentage. The sale of assets equivalence percentage is looking at what is the value of the asset that is being sold, and that value is calculated using a standard valuation method, being either a discounted cash flow or a price earnings type valuation, or a net asset value calculation, whichever of these accepted valuation methodologies is the most appropriate. We would then go and say, okay, let's multiply this out with the B credentials of the buyer, and we look at the buyer's credentials by scorecard indicator. So for instance, that would be your voting rights indicator for Black people, the voting rights for Black women, the respective economic interest indicators. And we do the multiplication out, and then that answer is carried forward for the scorecard indicators. And that being not the net value indicator, but only the voting rights and economic interest indicators. For the first 3 years after the date of the transaction, the sale of assets equivalence is recalculated. So we relook at the value of the asset after a year, we relook at the value of the measured entity after a year, and that relative percentage is updated in the calculation that is performed for each of the first 3 years. Thereafter, the indicator percentages are fixed, and the code is quite ambiguous in terms of its wording, whereby it indicates that that percentage that you calculate at the end of year 3 is then carried forward indefinitely. The net value part of the scorecard is calculated separately. When we look at the net value, we would look at the value of the assets that has been sold to the hands of Black people. We would then deduct the acquisition debt that has been incurred in the acquisition of that asset in order to calculate the net value. We divide that by the value of the measured entity, and that percentage determines what is the net value. The net value calculation on the scorecard is limited to the lesser of two formulas. The first is this formula A that we refer to as the deemed net value percentage calculation. And the second formula is your economic interest based on a normal flow-through basis. And in the net value calculation, we still need to do that test and ensure that we use the lesser of those two formulas when we calculate the net value. The sale of assets transaction is specifically included as a transaction that needs to be registered with a BE Commission as a major BE transaction if the value excludes 25 million. And that registration needs to happen within 50 days from the conclusion of the transaction. Also important to note is that it's very good practice whilst negotiating the sale of asset that one does look and include in the sale agreements that there should be access to the valuation, to this valuation of the asset that has been sold in order to enable the continued recognition, or rather the sale of asset recognition going forward. The equity equivalent program that is determined with reference to Statement 103 or Phase 2 of the codes, and this is particularly relevant to multinationals, where the multinational has a global policy that precludes them from selling equity in subsidiary companies or foreign companies where they have investments. The only time that you can qualify is where you get that approval from the DTIC and you've proven that you indeed have a policy which restricts the sale of equity. The mechanism for this is that there would be a program that is designed, and upon implementation of this program and approval by the DTIC, ownership points are allocated to the scorecard. And that means that only points are allocated but not indicator percentages. The type of programs would largely be enterprise supply development related, or research and development programs, skills programs, or also combinations of any of these. The specific nature of eligible programs would be programs that support government strategic objectives and policies and programs. Some examples being a equity equivalent program that is designed to support the Industrial Policy Action Plan or the Black Industrialist Program, the New Growth Part, the National Skills Development Strategy, or the National Development Plan. So any equity equivalent program that is designed such that it supports these strategic government programs would be considered. Economic development programs would be considered. Projects that transfer technology to SMMEs would be considered. Also, programs that promote economic growth, job creation, and then that leads to sustainable job creation. And these type of programs would be tabled to the DTIC for approval for recognition as an equity equivalent program. In terms of the quantum of contribution or the value of the programs, the quantum is calculated as being the greater of either 25% of the value of your South African operations, once again determined by an independent competent valuer using a standard valuation method, a discounted cash flow or a price earnings, or where it's applicable, a net asset value calculation, or 4% of the total revenue of the company annually. So the greater of these two, but there are provisions that require at least 100 million rand contribution if you want a 10-year recognition for equity equivalent program, between 75 and 100 if you want at least 7 years, between 50 and 75 million for a 5-year period of recognition, and for less than 50 million, a period of up to 3 years. There's also a provision that determines that if you proportionately to these targets design your program to a value proportionately to the target, you can get proportionate recognition of points. It's quite an expensive program, but it's certainly worth looking at for multinationals where the multinational does not want to give up or cannot give up shareholding and voting rights due to their global policy. These, as I've mentioned, the points are proportionate to the target, and you can also top up these points over time, as the program goes along, further investment can be made in order to add more points, and a minimum of 40% is required. A 10% of the value, target value, is required for a program. The process for an equity equivalent program, firstly, is to get approval to participate in this program. That entails an application process whereby, firstly, there's internal approval within the multinational that the local subsidiary can embark on an equity equivalent program, and a high-level concept plan is then tabled with the DTIC, as well as motivation of the policy that is in place. Line ministry approval is also required. Once that phase one step is done, a business plan, a full detailed equity equivalent business plan is designed and approved. The phase three part is that this is tabled with a committee, and approval is obtained, and then final points are allocated based on the program. Once the program is implemented, there's a monitoring and evaluation and reporting to the DTIC that is required. It's quite a lengthy program, between 8 and 24 months to get this approved and implemented by the DTIC. Some examples of programs: a very early program was HP, Hewlett-Packard, and there's been a number of programs subsequently. It's becoming a bit more common practice for these programs to be designed and implemented. If a company is not in a position to eliminate their level discount from ownership, or there aren't many other alternatives available from an ownership perspective, or if the company simply just wants to enhance a level or two levels, the Youth Employment Service program can be utilized to either improve by one level, or to improve by one level and 3 bonus points, or to improve by 2 levels. And these different enhanced levels are available based on the number of employees that are registered on the Y.E.S program and that participate in the program. For a one-level enhancement, the Y.E.S target needs to be achieved, as well as a 2.5% of the Y.E.S target absorption needs to be achieved. By absorption, we mean the permanent placement of these Y.E.S employees in the measured entity once the program is finished. The one level plus 3 points means that the measured entity would need to achieve 1.5 times the Y.E.S target and a 5% absorption. At a 2-level increase, the measured entity needs to achieve double the Y.E.S target and the 5% absorption. The Y.E.S program basically is an employment program whereby youth are employed through job placement. But if the measured entity cannot accommodate this employment, they could sponsor and pay for jobs to be placed in an exempted micro enterprise or a qualifying small enterprise. The type of employees that are eligible are Black people, per the definition of the codes, and they need to be youth aged between 18 and 35. There are a number of conditions to the Y.E.S program, that being firstly that new positions need to be created. The employment cannot be replacing an existing position. It's got to be a new position that has been created, an additional headcount position. The employment would be subject to the basic conditions of employment that need to be maintained and that need to be applicable to this employment. It would be a fixed term or a 12-month fixed term contract or temporary contract. And it has to be at least 12 months full time, unless there are unforeseen circumstances, which means that the employee leaves. In the case of such unforeseen circumstances, there needs to be at least 8 months of employment that has been completed. Where an employee leaves due not to unforeseen circumstances, the measured entity has 1 month in order to replace that employee. There are certain requirements to qualify for the Youth Employment Service Program. The first being to maintain and improve the BE status compared to the previous year's verification. This means that in the first year of participation in Y.E.S, that year's BE status must be maintained or improved compared to the previous year. Another requirement is that the measured entity needs to meet the 40% sub-minimum for each of the priority elements, or alternatively, they need to achieve 50% on average for each of the priority elements. The 50% average is calculated by adding up the points, excluding bonus points for each of these priority elements, and then multiplying that total by 50%. And if the actual achievement exceeds that number of points, then they qualify. The target calculation is the higher of three calculations. The first calculation is 1.5% of the measured entity's headcount in the preceding year, or the second calculation is 1.5% of the net profit after tax from South African operations, the average of the previous 3 years, and that is then divided by 55,000 in order to get to a headcount number. The third calculation is with reference to a table that I'll display shortly, and that is determined in the Y.E.S legislation. Therefore, your target is the higher of these three respective calculations. The target table, which is the third aspect of the calculation, is displayed here, and that is based on your revenue, your annual revenue of the measured entity. That determines a minimum number of employees to calculate the target.
Good morning, everyone, from my side. Yes, I'll take you through the more complex calculations, issues around complex calculations. I'm not going to go through a full calculation methodology with you, but I'll touch on some complex areas of that, and then also talk around some risks which we pick up in the in the industry, in our practice every now and then, which might create some risks on your side, on your ownership calculations, which might also be perceived sometimes as a fronting related risk, and how we can talk around that, how to mitigate those issues. So starting off with the complex calculations, one might think around complex calculations as a multi-tiered type of transaction, or a share ownership structure, where you have multi-tiers actually with a flow-through principle being applied. So actually calculating the effective black ownership through that calculation. And that is complex in itself, to be quite honest, especially if you want to start to apply modified flow-through principles, because you are allowed, once in your whole tier of transaction, you may allow or may calculate or deem one of your shareholders to be 100% owned instead of more than 50%, 51% black owned in that case. So applying the modified flow-through principle. I think the more complex situations that we do find is around the exclusion principle very specifically. I'll also touch on some aspects of the net value calculation in due course. But talking around the exclusion principle, that might seem to you some like foreign stuff for some of your businesses. Where do we find references to exclusion principle? I think there's quite a few references in the codes referring to that, but essentially the foreign operation or the exclusion principle refers to the exclusion of the number of rights of ownership, which is voting rights and economic interest, from the total rights of that measured entity's shareholding in that case. So in layman terms, it would mean actually that you will exclude a number of shares linked to those very specific shares that you are excluded. So calculating your ownership, your denominator will then be reduced. Now, immediately when you do the numbers, if you reduce your denominator in a calculation, obviously the result will increase. So yes, these type of exclusions may result in an seemingly artificial increase of your black ownership in such cases. Now, obviously, that has a positive effect normally on your ownership score, but you can run into situations where you report on extremely high black ownership numbers, and that might also cause some other questions, because the perception would be that you have done a deal of, let's say, 5% or 10%, but suddenly you report extortionate numbers of black ownership. And people start to ask the question, where is this coming from, why, and so on. And that is purely because of this exclusion principle that gets applied. So if we look at what type of items or ownership items can be excluded, the codes refer to very specifically 4 different areas of exclusion that may be applied through this exclusion principle. And by the way, if you go and look in the generic version of the code, you won't really find any definition of the exclusion principle. It does refer to the exclusion principle, but the amended financial sector code eventually included the proper definition of the exclusion principle. And it refers very specifically, firstly, that you must exclude any shareholding held by organs of state or public entities, and that must be excluded. Even the generic codes is very clear on that it must be excluded from your ownership calculation. So your denominator in that case. The second would be the exclusion of mandated investments. And I'll get to that now, that you may exclude, but you may also include it in that regard. So from an exclusion point of view, you may exclude up to 40% of your shareholding through mandated investments. The next one would also be non-profit companies and public benefit organizations, as it's referred to. So thinking around the wording of non-profit companies, public benefit organizations, you might find actually that you might sit with an organization like, for instance, an NPO or a type of a members organization, which is also for non-profit purposes. Will they count? I think in the substance of all of this, yes, it would count, because obviously the codes also refer to Section 21 companies. They refer actually to companies without the intent of making profit to be excluded. It is a technical, it is a gray area, but we have come across that, and we have been able to have a proper conversation with verification agencies around that to get an understanding on what can be excluded in that case. So your typical non-profit companies can also be excluded up to a limit of 40% to be excluded. Then the next one, the last component of this exclusion principle, pertains to the value of the foreign operations of a multinational business that operates in South Africa that can be excluded. So mouthful on that in itself. So meaning that you can, as a last resort, and in terms of the sequence that I mentioned, firstly, the organs of state, mandate investment second, NPCs third, and then this value of foreign operations exclusion must be applied after these ones. This foreign operations exclusion pertains to the business value of your South African operations that is gained from non-South African sources. It's very important that you exclude that you can also exclude that. And in fact, if you read in the verification manual, it very specifically states that the verification agency or the analyst must ensure that and obtain sufficient evidence to determine that the calculation of your equity interest excludes foreign operations. So it's an instruction that you must actually exclude that from your calculations. Now, talking around the mandated investments component, I think we've heard about mandated investments. Essentially, that is a third-party fund which is mandated by an investor to make investments, and that third-party fund is regulated by some sort of law in terms of the country. So thinking about practical examples here of pension funds, retirement funds, your collective investment schemes, policyholder funds, for instance, all of those type of funds are regulated by law in South Africa, and you as an investor invest through these type of funds. Those are referred to as mandated investments. Now you have an option here to either exclude, as I said, up to 40%, but you can also include. And the codes state that you are allowed to include and then just deem it as non-black, as it's referred to, or it can actually, you can actually get an independent competent persons report where you can then estimate the black ownership flow through from those mandated investments and apply that as part of your, and include it as part of your black ownership. Now, the big thing here is that the codes very specifically state that you cannot apply the exclusion of mandated investments and then also apply the modified flow-through principle together. So I mentioned the modified flow-through principle earlier. So you can't get that additional, I would say, enhancement by deeming a certain black shareholder as 100% black owned, and then also apply the exclusion principle pertaining to mandated investments in that regard. Going into foreign operations exclusions, and that's probably one of the more fascinating areas. If you look at multinationals, they might report some high black ownership, but you might think around them as a company that has a very low or very small B-BBEE deal, for instance, being done during the past few years. And why do they then report that high type of black ownership? Predominantly, there's a lot of factors, but one of the contributing factors would be the exclusion of the value pertaining to the foreign operations of that entity. Now, various indicators are being used, and if you look at it read it purely from a code, as I mentioned earlier, it refers to the business value of operations to be excluded. So you need to do some sort of evaluation methodology, and even in statement 103, which refers to equity equivalents, but also make reference to multinationals and South African multinationals to exclude the business value of their foreign operations. It goes further and state that this must be done through a standard valuation methodology to be done. Now, if you think around foreign operations, you might ask the question, so I'm exporting, is that foreign operations? No, that is not. So if you're a South African business and you just export services or goods, that is not referred to as foreign operations. If you have a foreign business, so running a certain business and you have foreign operations somewhere else, businesses running on that side, and you can attach a value to that business that you developed outside South Africa, that refers to the foreign operations that is intended here in the codes. So the valuation of that very specifically refers to standard valuation methodology. This type of methodology requires you to apply standard market practice, what you would apply to value a business anyway, and what you would apply to value your business. So it could be quite a complex process just to do that valuation on an annual basis. We have seen some companies also applying different mechanisms, and it's actually open in the market and in the industry that companies sometimes apply even an indicator like, for instance, EBITDA or revenue splits, even for that matter, or even sometimes asset splits. That's probably a little bit more aligned to valuation to calculate the split in foreign operations on that side. Where you have complex groups, it might get quite interesting. Let's say you are the entity, you have foreign operations yourself, and you are owned by another entity which also has some other foreign operations, and that black ownership is flowing through into your business. Typically, when you do the shareholders black ownership calculation and the foreign operations exclusion principle on that shareholder basis, that company will inevitably also recognize the foreign operations pertaining to your underlying business as well. So you might run the risk of actually a double counting, double dipping in this case. So it's very important that you take note of that and that you apply it properly. So you might, for instance, apply the principle of calculating the foreign operations based on your business and excluding that foreign operations mechanism on your shareholders. So just applying the pure flow through black ownership from your shareholder to see what is the impact. You can play around with that and obviously see what is the best impact for your business at the end of the day. We have various examples of businesses that we do this type of scenario planning for them, and also have the discussion around the narrative as well, because that's quite important actually, that you know what you're doing and why you are doing all of this. Getting into just net value calculation, Eric touched on that through through some of his areas, very specifically on sale of assets, for instance. I want to touch on a few areas of the net value calculation, and we have run about a year, 18 months ago, we have run a net value workshop webinar like this, actually, where you can download that from or access that from our website as well, where we delved into the net value calculation in detail. Some of the complex areas which we find is very specifically the valuation of the shareholders and very specifically the valuation of the black participants' holdings. Where there's very specifically, if you read carefully in the shareholders agreement, subscription agreement, sometimes that you might have some limitations on that shareholding. That might impact the transferability of that shares and obviously also the value of those shares. All of this must be taken into account with the valuation methodology. And by the way, when you need to provide a valuation, there's very specific requirements which is prescribed by the verification manual. Once again, the Bible of the verification agencies on that side. They need to inspect this valuation for the professional competence of the person, the objectivity of that person, the source data that was used, the assumptions and methodology that was used, for instance, and also then obviously apply a reasonability test in terms of their knowledge of the business and this valuation. So you need to take into account a lot of factors actually when you do a valuation, and it cannot just be a back of a cigarette box type of calculation, so to say. Acquisition debt is probably one of the most contentious areas which we come across, and companies constantly request us what we refer to as acquisition debt. Now, acquisition debt very specifically refers to this debt that was that the black shareholder incurred when they acquired this shares. So that refers to acquisition debt. The black shareholder might at some stage go and encumber the shares for another deal or for some other operations or for some other reason. And sometimes that gets confused with this acquisition debt. That is not acquisition debt. That was not part of the acquisition of the shares and should not be taken into account in your net value calculation, so to say. So it's important that you distinguish between what applies to the net value calculation and what applies to normal business practice on that side. When we start to look at risks, typically if you hear the word risk, then you would want to think around the whole issue of fronting, because that's where a big risk is sitting in ownership transactions. And very specifically, if you look at the definition of fronting refers to the frustration to a large extent of the objectives of the outcome of the objectives of the act, or even to any of the other areas of the BEE legislation, like the codes and so on. So on a high level, the objectives has the intent to promote economic transformation for Black people, meaningful participation in the economy, racial composition to be increased in ownership and management. And so we can go on for communities and workers to own and manage existing and new enterprises. All of these objectives are linked to some sort of participation by Black people and increasing participation by Black people in certain constituencies, and also talk to the access to funding very specifically for Black people to have effective economic participation. With this backdrop, one might then look at transactions and ask the questions whether you are aligned with these type of objectives, and whether your transaction will pass the test of that. So looking at some of the risks that's related to ownership structures, especially if you look at the structure where you have an existing white shareholder and a new black ownership company, or black shareholder buying into the company or acquiring the shares in some other form. You might look at direct and indirect control, very specifically pertaining to these type of structures, especially if you have SPVs in between, and where there's a split, for instance, where the white shareholder still has a component of the shareholding together with the black shareholder in that case. That might refer to more indirect control in that case, instead of leaving the shareholder, the black shareholder, to make their own decisions. So there might be a perception that there's actually control still held by the white shareholder in that case. And one needs to be very careful on how you structure these transactions, so that you're not running into the risk of being perceived to still control the black shareholding for the benefit of the majority shareholder in this case. Inevitably, together with that, one would look at the board representation of that business. And it's not to say that if you have a BE deal, there must be a black director on the board. Thinking about a 1 or 5% deal, for instance, it probably will not suffice to have a black director for that number of shares, for instance, depending on what you agree in your shareholders agreement. But where you have a more substantial type of black shareholding in the company, and your board in that entity is still untransformed, you might ask the question, what's going on here? Remember, the shareholders decide on the appointment of board positions. But one would expect that if you have black shareholding, that you will also have some sort of representation on the board of directors. Not as an executive director necessarily, but at least as a non-executive director. So that is definitely something that one needs to consider. The codes also refer to options as a mechanism to achieve black ownership, and there's very specific rules regarding that in the code. One should consider those options very specifically for what it is, and very specifically make sure that when you apply options in your ownership structure, that it has that there's substance to that, and it's not just a mechanism of avoiding real black ownership and getting a black shareholder through an option which you will know will probably not be exercised in time. So option agreements can be applied, but I must admit that there could be some real risks. And I have seen in the last few years companies starting to frown upon, especially your procurement department starting to frown upon some of the option agreements of their suppliers when they disclose their black ownership transactions. So make sure that you do the right thing in terms of options. Black private equity funds, it's probably one of the flavor of the month at the moment. You need to ensure that you have the substance again of the transaction. Sometimes you may come across a type of a manufactured type of black private equity fund structure, where you as the existing shareholder might be part of that, even of the management company which manage this fund. Actually, just for you that don't know, and I know we're running out of time, private equity funds is typically a third-party fund where you invest through such a fund, and the funds are managed by a separate manco or a general partner, in that case a specialist entity. So essentially, for the purposes of recognizing black ownership through a private equity fund, to get black ownership through that, the manco or the management company of which manages funds that gets invested must be independent. I think that is the biggest risk, and also the requirement in terms of what is the substance of a Black private equity fund. That is that majority of the decision making are done by Black people independently from any other party, like the investor itself. So you trust that investment manager to make the right decisions in terms of the funding. Yes, that can be used to get Black ownership in your business, but make sure that you clear of round tripping and all of these type of things that happens where you invest your own money actually in a fund and you get Black ownership through that. It's nothing else than really blackwashing of white money, to be honest. Sale of assets, Eric spoke about that very specifically. I think the risk for me here is that companies try to manufacture type of transactions just to get Black ownership through buying an asset and selling it at an inflated price sometimes. Yes, there are requirements from specialists that must obviously sign off on the fairness and reasonability of the values. And that is very important that those specialists must obviously do their job to ensure that you don't fall foul of these type of issues and requirements.
Everyone, thank you very much for joining us today. Also, please keep a lookout for future webinars that we'll be hosting, and we hope that this was informative. Thank you very much.